Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, January 22nd, 2019. I hope everybody had a nice long weekend, at least for those of you that had yesterday off. Markets were closed. It was Martin Luther King Day here in the U.S., so I took the day off. But as we're getting back into trading, there's some important developments I wanted to point out. So I'm going to keep this video for members only because I'm going to show you quite a few different charts. It won't be a long video. But there is a term, I make a lot of terms up in trading. You probably noticed that on the site, a lot of things you haven't seen elsewhere. One of the terms I use, I call it technical syzygy. Syzygy is when all the planets are in alignment, when you have three or more celestial bodies. So ironic that we had that blood moon on Sunday night, the lunar eclipse, and that is an example of syzygy. So when in trading, when the charts are aligned, that's what I'm referring to here in technical analysis. So right now, for example, we have, let's look at the futures before we get into, here's QQQ, which is an active short trade. Remember, I added that on Friday. So far, our entry was a pretty spot on. We shorted near the highs on Friday, which could mark the, I think, the end of the at least the initial leg up off the lows on the was it December 24th. Like again, I'm not looking for you know what? I shouldn't say that. I'm open to anything, any possibilities, and that's one thing I will strongly urge you. And at any point in time, try not to become married to any one view. I do suspect we'll get a correction here. I'm still looking at, which is now, and as I said last week, about a 5% pullback is what I'm expecting in the markets. Um, but and then followed by another thrust up to take out last week's highs, and that may mark the end of what I'm still viewing as a counter trend rally, a bear market rally. However, I'm open to all possibilities. I mean, it's possible that we had a big run up, and maybe we do go down and retest or even undercut those lows. But again, let's not get too far into that. Right now, we're looking ahead. And I did make mention, I believe I made mention last week on the QQQ short trade, which we were looking at here a second ago, that this trade has the potential to morph into something more and possibly into a runner trade. See, right now I have a potential third target down here. These are the official targets right there. I should do something like that. There we go. Um, and depending on what happens and what I see in the charts, there's certainly the potential to allow for a runner trade. What is a runner trade? Well, a runner trade would be if you did short QQQ on Friday, or if you waited today. We're now below those wedges I talked about. You can see here on the 60-minute chart. You can set a stop at, or leave your stop where it is right there, or set a stop at entry if you want, and trail your stop down along the way, because there is a potential that we could go back and undercut the lows back from December 24th. So that's just a possibility. And that's what I call a runner trade. So if you're profitable, you continue to trail stops down. That will, assure you a profit on the trade, but it leaves the door open for a much larger move that might catch a lot of people off guard. The price action has been extremely strong recently, and trading 101, let your winners run and cut your losers. So that's, again, right now, I don't want to get too far ahead. Let's just see if we even get to the first target. Second target, we'll go from there. So I'll continue to update this trade and do a lot of updates on the markets. But let's back to the charts. I want to talk again about how the charts are in alignment. So, in fact, let's look at the futures. That's, I think, what we ought to start with here. Futures tell a much clearer story. All right, there's crude. We're going to get to crude in just a second. I just threw out, right before this video, I got a short trade out on crude via DWT, the 3-time inverse. My confidence is that high on the trade, or I wouldn't have put such a large position size. Normally, when I use those 3-time leverage ETFs, I personally, if I'm trading that, and I trade crude futures on this one, CL, but on the official trades, I will adjust that down to account for the 3-time leverage. In other words, that would have been normally a 0.35 or so percent beta adjusted position size. which would be 1/3 since you have 300% leverage in there. And this time around, because it's quick, and the reasons again I cited on the post on there, I went ahead and just used a full position size, which is really a 3 times weighted position in crude. Now, here's where back to what I said in the beginning of the video about the charts being in alignment right now. This is ES, the S&P 500 E-mini futures. I have modified these trend lines from last week. I wanted to point that out, but I did that for a better fit. The charts are dynamic, and so is my analysis. And that's, again, I don't become rigid to anything. If I had a trend line, and I did before, I had a trend line that was coming in here and capturing like these lows, but we had one break there. And either way, you could look at that trend line. I think that one was still valid with a little whipsaw signal there, but now we've broken this secondary alternative trend line after dancing on it this morning. So point I'm trying to make is here's a sell signal on the US markets. So last week I said I shorted we added QQQ as an official short for what I believe to be an imminent breakdown of these wedges. So now we have that breakdown there. Let's see, let's go to NQ, that's ES. Here we go, NQ. There's a yellow uptrend line breakdown. I had an alternative trend line here you can see on the chart as well right here, which has also just been taken out. And we danced on it. It helps validate it. There were quite a few reactions along here, a couple reactions there. We danced along it all morning here and finally broke down. So that's confirmed sell signals. And of course, we're below the main uptrend line on that 60-minute bearish rising wedge. Negative divergences, everything I've been covering now for weeks, really. We've been building these divergent highs, and to me, it was more of a matter of if not when we get a sell signal here. So I think the sell signal is in play on the U.S. markets. I tell you, I would like to see some impulsive selling. I'm expecting that this week, but we really want to see that to help validate the breakdown. So maybe today we get a big move down. That would do the trick if we have a solid red close today. Let's say 1.5% or better. And of course, the bigger the red candle, the more bearish that is, and the more it helps to validate the breakdown. So starting out here again to rehash, there's sell signals on the U.S. Equity markets. As you know, I just put out the short trade this morning on DWT, the 3-time inverse for crude. You remember, if you're new to the site, I don't put options or futures on there because many traders don't have the experience, they don't have the access in their accounts for options or futures. Just about everybody can trade inverse or stocks and ETFs, and those are the official trade ideas. So, but if you are, if you do trade futures, I posted this in the trading room this morning before it broke down, stating that I would most likely add the crude oil or maybe some of the energy stocks as short trades, and you can see we have an impulsive breakdown since then. So there's a sell signal number 2, and I've also one of the reasons for the overweighted position size, and I left this out in the post this morning. I've stated recently there's been a very, very strong correlation between stock prices and crude oil. And it's not coincidence. People think, okay, if the economy, we dodged a bullet, it was a correction in the third or fourth quarter, great buying up. This is what I'm talking, what the masses are thinking now. So the economy's strong, we're going to go to the moon, market's going to the moon. And as you all know what happened in the stock market, well, crude went right along there with it. There's December 24th. Not by coincidence they bottom on the same day. This is not supply and demand driving it here. This is expectations of future growth. Just like when the market was plunging, crude was plunging because, again, everybody thought at that time the world was coming to an end. The U.S. economy was just going to crumble. I said it wouldn't, and we'd get a big rally. Now that we've had that big rally, I think everyone's seeing that it's overdone. Either way, right or wrong on my fundamental thoughts, this is a very clean textbook bearish rising wedge. Hence, again, my reason to use an oversized position on this short. And we're getting there pretty quick. We could certainly go down more. So the same thing holds true if you shorted that one. Maybe you came into the weekend, the week short crude. But let's go to that chart real quick. You can also allow for a potential runner trade. So we broke out. This is DWT, which is just flipping the charts of crude oil upside down. Those are my targets. And there is a potential could morph into more. In fact, I have a line all the way up here around 14 on DWT that if things got really ugly, and that's still from where we entered today. I'm trying to hold the crosshairs there. It'd be about a 36% gain. I am not extending that target this time, and I probably won't. I'll probably take profits. Possibly on T1, I could close it out early, but almost certainly at T2, maybe recycle back in. At the very least, my expectation is to get up here, hit these target areas, maybe consolidate for a little, even if crude is going lower, and that would look like this. Otherwise, we just pop up here, maybe come in, back test the wedge, get another shot. Let's just look at USO for those of you that do not like the leveraged ETNs. There's USO on the 60-minute chart. I need to tighten that line up. There it is. So you can see a nice clean, let's move that up here. That comes in pretty good. A nice clean 60-minute bearish rising wedge. And again, guys, it just doesn't get much better than this. I cannot promise that any trade will pan out. But I can tell you that these charts look about as good as I've seen in a while. And again, it goes back to what I was saying in the beginning of the video. All of this is in alignment. Now, we don't just have crude oil and the stock markets. Let's look at one other thing. I pointed this out last week too. Treasury bonds. This is ZB. ZB are the futures for the long-term bond. We call it the long bond, the 30-year Treasury bond. Those are the most rate sensitive, but treasuries again are historically a flight to safety instrument when the market corrects, when there's weakness in stocks. Individuals and primarily institutions, the smart money, they'll move into treasury bonds for safety. And you can see just a beautiful bullish falling wedge pattern. Very, very well-defined support. Again, I covered this before. That's about 144, 130 or so right there. And I had an alternative trend line here, a lot like I think I just showed you on NQ. We've broken out of both of those. So this is a breakout on treasury bonds. What does that mean? It confirms what I'm seeing in the stock market, that treasury bonds were set up bullish. I mentioned last week, scaling out to pretty much, bare bones position out of most of the equities in my long-term accounts, and then moving that last week, I transferred some into bonds for the first time in a while, back into bonds. So I was, long treasury bonds when things were falling back in the last quarter, and I'm looking now for a pop here. So there's another unofficial trade idea. You can certainly trade it if you want to. Maybe I'll make it as an official. There's not a lot of meat. You really have to leverage up on treasury bonds because they're relatively stable. In other words, if you're going to trade, whatever your number is, whether it's 1,000, 10,000, 100,000 per position, if you trade 10,000 on a normal stock or ETF like QQQ, you can do 2 or 3 times that easily in treasury bonds because the moves are much smaller. So when I talk about baited position sizing, you would have an overweight position size on treasury bonds. This would be my uppermost. This is really my bounce target zone right here for treasuries. So you can see the uppermost target levels and the lower. So those are, again, that's what we call the long bond, the 30-year treasury. And somewhere on here I have, if I get to that, yes, the shorter term bonds. This is the ZT is the, what is that, the 5-year, I believe. Let me check. No, that's right. It's a 2-year. This is a 2-year treasury bond. So these are what they call notes when you're, down that short treasury note. You can see there as well. Let's bring that line in. You could play around with it. This would be the trend line at this point in time if we get another reaction here. But again, story is the same. You have treasuries all the way out. I showed you the longest term down here to the almost the shortest term, these 2 years. And you can see just a nice bullish falling wedge pattern. So this tells me it aligns with my outlook for the markets, because if stocks do correct and we have a 4 or 5% correction coming, you would expect to see money come into treasuries. So here's another trade idea for you guys if you trade short-term treasuries. SHY is an ETF that holds short-term treasuries. IEF is midterm, medium-term, 7-10 year. And then, of course, you have the long bonds, which are TLT, if you want to use an ETF. So there's another trade idea. And that's it, really. I think we can wrap it up here. So I've showed you the outlook for equities clearly looks bearish with those breakdowns on the 60-minute wedges. Bonds confirmed by looking bullish with these 60-minute bullish falling wedges. And of course, crude oil, as I showed you before, also looks bearish. Here we go. And also note it's been trading in line with equities and expectations for economic growth. And finally on that, before I'll wrap up here, what I wanted to show you. As I expected, we're seeing now, this is from the Wall Street Journal today, the daily shot that they send out as a, just a collection of charts. And it's showing us that a lot of expectations are finally slowing down. And, again, if you recall back in the last quarter, in the fourth quarter, right, as the correction started getting underway, said you'd see economic growth expectations revised downward because of the drop in the market. It would then cause consumer sentiment to drop. But as we came into the lows, leading up to December 24th, I said, well, and then you would see the opposite. You would see start to hear a lot of buzz. Hey, the economy is not falling off a cliff. Economic indicators are still strong. And then you get the rally. Now we've had that, but what I'm getting at is sentiment is fickle, and it ebbs and flows just like the tides. And now we're seeing that consumer sentiment is really starting to drop, and therefore, as you go down through these charts, a lot of these expectations, businesses are concerned. There's all kinds of charts in here that show you consumer sentiment is dropping, and when sentiment drops, then the economic forecasts go down as well. You can see, and that's again what all these charts are talking about here today. And this again just came out. So this is the ebb and flow that you get with the financial markets. Things get, especially right now in this environment, and you saw that in really since really last quarter, just how quickly both stock prices can change and sentiment as well. So everybody was bullish last week, thinking the market was going to rocket to new highs, and I think that got a little ahead of itself. And again, at this point in time, my primary expectation is not for anything huge, but I do think if you sit tight, I think there's a good shot we'll finally get that, which is now, like I said, about I'm on crude here, but about a 5% pullback in the markets, at least 3, but I'm closer to leaning towards 5% now. Actually, I should say from remember we on Friday we shorted darn close to the highs, and so if I hold the measuring tool there, if we do hit my second target, a little up here, 155.79, so we're up here. Oh, I've set it quite a bit above that support level. We're talking, actually closer to about a 6% drop. But I'll keep an eye on these targets. What I'll do is, as the charts develop and I'll watch the futures, I may revise the final target. I can tell you right now, the first target will remain in place, 158.81 on the QQQ short trade. It's a second target I may fine tune if and when we take out that level. All right, let's wrap it up here so I can get this thing out to you guys. So far, the markets are down, but they're not really falling sharply. QQQ is only down 1%, SPY 0.83. So I want to add that too, that I still think it's an objective time if you didn't short Friday. I understand a lot of people don't want to short into strength. They don't want to short a market that looks like it'll never stop going up. But this is still very much an objective entry, as is the entry on crude oil that I showed you earlier today. When it's not objective, well, when you get close to the first target, you don't want to short right here, right above support. If you do that, you risk getting caught in a kickback rally. Usually we don't go from point A to point B without some zigging and zagging in between. So a trade like this would play out somewhere along these lines. So this is your objective shorting op. This is where you can either cover, book partial profits, or hold on for the full thing and maybe lower stops when that first target is hit. Other than that, the next objective entry comes on a solid break below the support level, which is placed at the support levels at 158.74. Remember, I always cover a little bit above the actual support level or the area I expect to bounce, and I do that to help avoid missing a fill. But then if we do break that 158.70-ish level with conviction, and ideally what you want to see as well as we fall down there, you want to see reaction, a little consolidation that helps to work off the near-term oversold levels, and then a breakdown to that final target. Okay, we will wrap it up here. This has been Randy Finney with the right side of the chart. Hope you enjoyed it.